Hi, it's Shani Graber.
No, it's still there.
Coordinated debt mezzanine fund, primarily buyout. We also, our funds, we operate at the middle market.
Quick sound check in the back. It's hard to hear. And we were anticipating this might happen. Sorry to interrupt. So there are mics. This one will be the Zoom mic. So don't miss that.
My name is John Kammerer. I'm the business tax tax partner of Redpath and Company. I specialize in business tax primarily. I'm also on our company's board of directors.
All right, so first we're gonna just start with Ron giving an update, go through some slides here and talk about general market.
So I thought it would be helpful, I got 3 slides to set the scenes and give a little bit of real data before we talk, and then the panel can agree or disagree with some of the data and the trends. But this is hard to see. We're happy to give the slides to anyone as well. But in the upper left is middle market M&A volume. And this is deals under 500 million. Through 9 months of last year, the market was up about 10 to 15%. I think that'll be true for the year. With large deals, you'll see the volume was way up. Read these mega headlines, but the middle market is more stable. But again, it was a nice year. In the upper right, average transaction size. Again, this was for deals. This is for deals under $1 billion. Went from 185 million in 2020 to up to 380 million. The reason why that occurred is because the financing market got much healthier. At the bottom of the pandemic, the banks were a little tight. The deals that were getting done were a little more distressed or stressed. We're back to kind of a very robust financing market and average transaction size being higher, which to me is a sign of financing strength. In the lower left, deals under $250 million, debt. Total debt was 3.9 times, with senior debt being 3.2 times. That's kind of the bank market overall, and mezzanine was squeezed a little bit to 0.7 times EBITDA, but basically back to a high water mark. And I think you'll see this tick up a drop when the full year data comes out. The market was clearly strong at the end. And then the bottom right, unitranche deals, 5.8 times. So what used to be 5.5 is now kind of 5.5, 6 for the direct lenders, non-banks on total leverage. And then
you see the uptick in deal activity last year. What do you think the key drivers were? Tax policy and tax policy and tax policy, or anything else?
I mean, we'll talk about that more. There's lots of reasons. I think that there are tons of tailwinds on M&A of people that got scared, tax policy, economic stimulus. There's, other than a lot of uncertainty, almost everything is supporting a robust, transaction market. On the next page, M&A valuations on the upper left. I look at GF data, which tracks private equity only transactions below $250 million. And those deals went up to 7.2 times overall. And that's averages hide, the details. There's obviously a lot of deals we'll talk about going on way higher than that. Tough deals are still tough, but again, back to kind of a high watermark. In the upper right, PitchBook tracks all deals, 9.5 times. And there's data out there, depending on what source, 11 or 12. And that number is going to tick up because there's a number of deals being done. We'll talk about it, 15 plus times EBITDA. I think the lower left is pretty interesting. When you look post-pandemic by quarter, look at the last 4 quarters, 6.6, 6.8, 7.0, 7.2, 7.6. As last year progressed, pricing just kept increasing. So that's pretty telling. And the lower right, by transaction size, In the left is a 13-year period, where small deals, $10 to $25 million were 5.6 times, and $100 to $250 million deals were 7.7. A 2-turn difference. That is now a 3-turn difference. Size matters more than ever. Bigger deals, 100 to 250, 9 times, and small deals up by half a turn to 6 times. But the old private equity, the bigger you are, the more you're worth, the more you can borrow. That spread of quality of size matters more than ever. And on the last page, just a little bit about the money flows. Private equity deal activity. This is only 9 months of data. It will be up again. I kind of said 10 to 15%. Private equity funds, Shani and I were just talking. Actually, the number of funds might be down, but there's a proliferation of independent sponsors, family offices. There are more pockets of capital now than there have ever been. They're just more diffuse. And fundraising has been great. I was just saying, I'm on a couple endowment boards, and every endowment board is allocating money to both floating rate bank debt, which is the direct lending market, and middle market private equity, given public market valuations. I'm pretty bullish on the outlook for those capital sources, and it's supply and demand in our market. That's creating the demand, is the capital that is clearly out there. And we'll talk a little bit about supply. Lower left, private equity funds now have about $1 trillion of dry powder. That's equity. They can lever that 4 times. So that's $4 or $5 trillion of buying power. And the last chart, add-ons are 70% of financial buyer transactions. It's pretty hard being a private equity fund saying, hey, I'll learn that industry. I'd love to buy that company when we call hundreds of parties on a deal. But if you have a portfolio company and you've got a platform, you can get the multiplication, you can get synergies, and a majority of the deals by far are going to be add-ons and drive that growth and that multiple expansion. So, overall, I think it's a pretty good market. We'll talk about some of the underlying trends, but the supply-demand equation, the companies coming to market, the valuations, the lending market are all supportive of a pretty robust market, and I see that continuing for the foreseeable future. So, and with that as an overlay, we can kind of turn it back to the Q&A.
So before we move into actual Q&A with the panel, is there any other questions? Kind of move forward.
You think multiples are going to take a hit with the black swan coming up with Ukraine? Is it possible war, or is that just not even affect?
And could you repeat the question, please?
Yeah, so the question was related to Ukraine and possible war there. Do we see that is that going to have a significant impact to what we're seeing in the market? Ron, you want to take
I kind of would say no. I mean, the public market valuations and stability in the long run are correlated to the M&A market. In the short run, they're not. So if we have a prolonged period of instability, yes, you will see that. I actually think you have a little bit of slowness in January coming to market, given how robust last year was and a lot of the uncertainty in supply chain politics, interest rates. I'm pretty bullish for the year, but January is not that robust right now in deal flow coming to market. A little bit about this period of uncertainty. I don't think it's affecting valuation yet, and that could change.
Yeah, I think one interesting part about that, if you look back to the pandemic, it's pretty similar where capital markets closed down. No one was really lending. It took a while for the world to figure out what was going to happen from a pricing perspective. But once it started to open up, we ended up seeing that backlog of deal. And that's a big part of what we built into 21. The back half of 21.
Know how to do it.
So if there's no other questions, kind of just move in. And I think the first thing I want to talk about with Ron a little bit is we talked about overarching trends, but I'd like to focus a little bit on industries. And can you talk a little bit about some of the industries you see as hot right now, or one that aren't?
Sure. There's a lot. If you look at the data, technology, and some healthcare are a disproportionate amount of transactions. I think in the more industrial and consumer worlds, anything around the home, not real estate a little bit, home building, but that's still a little bit cautious. But if you're maintenance, HVAC, services around the home are, or pet, the pet market is incredible right now. Infrastructure, with the transportation bill and the aging infrastructure, there's a lot going on. Water. So those are all themes that are very attractive, and then a bit of the changing energy infrastructure, the equipment going into that. You see that in electric vehicles, but if you're, where can you see above average growth? Those are areas that I think the market is more favorable to right now. Shani, you have
I would agree, and just kind of digging down into the healthcare, we're seeing a lot of home healthcare, as people are moving away from hospitals and long-term care and providing your care in the house, medical devices, disposable medical products. Obviously, with the pandemic, healthcare, hospitals, home health, these are all things that we're seeing, and they are just exhibiting very, very strong growth. I would echo a lot of things that Ron said too, in terms of consumer type of products, home type of products, and even just the auto market. Even though there's this chip shortage and OEMs are kind of up and down with their manufacturing, the demand for cars is out of control. Electric is driving some of that, but the demand is just far outpacing the supply right now. We do that in car dealer a lot. So any of our companies that manufacture parts that go into automotive are just seeing a very, very strong demand.
A question for you in regards to allocations to, for instance, the ESG space. Are you seeing a lot of shift there, especially as it relates to climate and things of that nature?
So the question we have is, have we seen a shift in allocations towards the ESG space?
That's a great question. So I don't know that, I wouldn't say valuation for ESG themed companies is higher. This is the first year that I think every private equity fund, public companies were on ESG, multi-billion-dollar funds were on ESG. It's a topic of conversation at a $300 million asset private equity fund for the first time this year. And they're reporting on everything. Like within their portfolio companies, on the management of their firm, on other stuff. It's really interesting seeing it cascade down. I don't know that it's affected valuations of portfolio companies or that I'd be interested in.
We're seeing the exact same thing where dedicated dollars are being allocated to those types of investments. And ESG it's a very broad category. It's, when you're talking environmental, it could be, water treatment, ag related type of investments. So it's very broad, but we're talking about it at our firm, and we're probably going to dedicate some funds to that investment. It is definitely a topic of discussion across all private equity firms. Whether they're actually doing it or just talking about it, it's definitely a topic. Sorry, question.
Thank you. Interesting answer. Esg was moving.
I just at CIBC, it's amazing how we've repositioned our bank to try to be a leader, from banking, economy, energy companies to it is everything our institution is doing. But that's a large cap company. But seeing it cascade down to the smallest private equity funds, you can't ignore, you have to embrace. And people are doing it already, and your LPs are demanding it. But I've really seen a big shift in the last 12 months to our market, really. I'm surprised that Shani's a step ahead at $1 billion fund. It's been on the radar for several years.
Okay, and we talked about industries and now brought it to ESG. Let's talk a little bit about the valuations. When you're talking about some of the different industries, how are those trending?
It is a crazy spread of valuations right now. There are the top decile transactions, top 10% could be 15 to 20 times EBITDA. And if you've got high quality management, double-digit growth, strong gross margins, a moat around your business, actionable M&A pipeline with public market valuations being what they are, some of these prices, I've pitched 15 times and lost. I just pitched a deal that had 10 million of EBITDA. We said it's worth 350. And we're trying to and the owner thinks it's worth more. So that there's a pocket of, because 2 years from now, EBITDA, it's selling the future of what 2 years from now EBITDA is going to be based on contracts and other stuff. On the other side, if, the melting ice cube, some old economy businesses, tough deals are tough. If there's a declining business or a pandemic winter where EBITDA is double what it should be, valuation can be challenged. People don't want to do, as many tough deals. So it's all over the map on it for good reasons, but a wide range. When I give an average of 7 or 10, that's, there aren't many deals that are in there. They're kind of spread out.
Oh, yeah, it's been a crazy market. We've seen these types of multiples. We did a deal this year, a typical distributor, distributing parts to the automotive market, industrial, and a couple years ago, this would have been a solid 8 to 9 times deal. This was a solid double-digit deal this year. It's a nice company, nice cash flow, but literally probably 2 times more valuation for the same company, and they performed well through the pandemic. And I think there's a premium for those types of companies who have performed through the pandemic. We had a company that sold this year, so we have the benefit of some of these high multiples, where it was in the health and wellness space, which is another industry that's that's pretty hot right now. And the company sold to a strategic for about 18 times. And this was, the company had grown. It was about a $60 million EBITDA company. When we bought the company, it was about 15 EBITDA. So they've grown so nicely, and just, again, the growth in this health and wellness space, especially through the pandemic, and it just sold for a crazy multiple. So we're seeing exactly that, and I don't see it coming down for this year.
Say, what we said, 7 is the new 6, but like 12 is the new 8. And 15 or 18 is the new 10, is the new from 10 or 12. If you look at it, it's really expanded when you go up on this premium for quality.
And Shani, wanted to follow up on your example that you had. So in the cases where you're seeing those valuation multiples slip upwards, on the lending side, there's going to be ROI and some premiums applied, but from the investor side and kind of expectations, has there been a change in focus on sustainability of earnings, or kind of where's the focus and where's the valuations going with that?
Yeah, it's as the valuations are creeping up, I'd say the leverage and the lending multiples are also creeping up incrementally as well, because you still have that significant equity cushion underneath you. I mean, if a private equity firm is paying 15 times for a company, there's a significant amount of equity in that company that is supporting the business. So yeah, and performance through the pandemic is a key driver to some of these high multiples and high leverage multiples. Wait, answer your question.
I think so.
Question from our online audience. They were asking any comments on revenue multiples, startups or not yet profitable. Same story or something different?
So the question we have there relates to revenue multiples for startups and really any negative earnings business, people that haven't turned profit yet, and we're seeing the same story.
So, yes, in software business, we have a growing business, pretty substantial business in software companies that get to like 5 million of ARR. So if you're below 3 or 4, you might not get that, but once you have 4 or 5 million of ARR, you're valued on a revenue multiple. And that's a precursor to profit because you might not be making money, but there's a tremendous demand for software deals that trade at revenue multiples. And it could be 4, it could be 10 times revenue, plus depending on the growth rates and the margins, on the earlier stage, not really my market.
Yeah, I worked on a few recently where 18 to 22 on the revenue multiple has been out there. One of the businesses had negative 20 million in EBITDA, so it kind of shows you the cash burn that they were going through, but they also just achieved 100 million in ARR. So in those cases, that's pretty significant sized deal that people are investing, even though there is negative cash flow at this point. So then, as you're talking about the startups and the revenue multiples, I just mentioned an example of negative earnings. What are people really invested in those cases? Do you have any view of that, Ron or Shani?
Software.
Yeah, I'd say this is going to be more applicable to software.
Yeah, I mean, look, if you have 80-90% gross margins, it's just a scale issue. And those companies can scale very, very rapidly. You look out, our job as a banker is always to sell the future. So is it, can we sell 5 years from now, 2 years from now, last quarter annualized or the last 5 years? If you've been growing, 5 million of ARR a year, and you just keep doing that and you put the math forward, ultimately every company is the present value of its cash flows, but the math on rapidly growing high gross margin businesses, those negative cash flows reverse pretty quickly.
Yep.
Excuse me, I've got a question. Regarding, can you comment on your confidence with staffing challenges? Because you made it sound like, oh, all they need to do, if they got 80 or 90% margin, they just need to scale. And
so there is,
I'm curious.
So, I mean, labor, we've got the challenges in the market, the labor constraints. Almost every one of our clients has more demand than they can handle. Rising raw material prices and not enough labor to fulfill their demand. So it is an incredible challenge. And I actually would say that people being an employer of choice, the ability to attract and retain talent is going to be an incredible focus for the investor community. And we can just hire an extra 100 people doesn't work anymore. So the core competence of labor is absolutely critical. And we've been talking about this for a while. It's very material, but and that's why software, you don't need as many people. A tech-enabled business service where you have a back office, you have hundreds of people behind, that's a much bigger challenge. So we're starting to hear, investments where labor is less a component is getting a little more valuation and attention right now also.
And that'd probably be the same for digital transformation as well as automation, right? Any company, as you're getting further ahead of that, anything that you can take off people and put on machines.
So automation is a trend I should have said too. I mean, anything that takes labor out would be another trend that's getting incredible valuations.
Why is there a delay in people I know who are in the automation business? They say it's not just the automation of machines, it's whole system. The CapEx, the CFOs are not pulling the trigger. Everyone's talking, but nobody's actually pulling the trigger, at least at the moment. I mean, there's a lot of uncertainty at the moment, but is it just short term or is this really going to be 2022?
So the question we have is, we just talked about automation. Why aren't you pulling the trigger faster? Hearing in the automation space that people aren't necessarily see that investment made as much.
It's hard to get. I mean, when you're firefighting with labor and COVID challenges and supply chain challenges every day, you get taken off your long-term goals. And we've said this is a harder time for portfolio companies to operate than it ever has been. And so I think, those are deep challenges. But if you can't staff your shift today, it's hard to think about even the capital going forward and the uncertainty. I have no complaints about this M&A market. It's also the toughest business environment I think any of us have lived through. When you live with a company for 6 or 9 months in a transaction process, and the supply chain is going to change, labor is going to change, government policy is going to change. I mean, the company is not going to be the same, and you're trying to get double-digit multiples. So there's more change going on for all of us with our clients, with our portfolio companies. All of that, when the market pays for stability and predictability. So this is, again, no complaints as a banker in a robust market, but I think all of our jobs have gotten much harder to figure out how to navigate this rapidly changing environment. And they can't focus on the long run at the same time. Project 5 years. I can't tell you what's going to happen 6 months from now. And you want a 5-year projection?
I think another challenging part of that also is we talk about capacity constraints from a labor perspective, but what's it take to put automation in? What's it take to start doing some robotics? It takes people. It takes a lot of times you're hiring that. You're going to a third party to do that work. Well, I think all of us up here could probably talk about how we're struggling to hire people. Anyone in the companies are struggling to hire. So there's still a bottleneck with people, even if it becomes rolling in.
And supply chain shortages as well as backlogs, some of those types of problems. We're seeing that a lot with our companies, where even ordering and getting it set up is significantly delayed.
Yeah, I was going to say what we're talking about at board meetings is purchasing these large equipment for automation, laser cutters, things like that. But the lead times for those are so long that it's so far out in the future. Like what I'm saying, that you're kind of putting out these immediate hires and then planning for these longer term purchases.
I had a client that was adding 3 lines for automation, and they got board approval in 20 to do this. COVID hit, they ended up having issues getting contractors there to set up the cement pads and infrastructure on the electrical to be able to do this. Once they got that installed, about 6 months after they originally had board approval, then it started to order the machines. Those were supposed to come from Europe, and nothing was coming in from Europe for about 12 months. They finally got them in while we were doing our diligence process. As they were coming on board, they couldn't find people to install them because of the labor shortage. All in, it took them 24 months from board approval to actually getting something there that they could start installing. Not even using, they're still expecting probably a good 6 to 12 months before they could actually use it. So that's just one example, but I think it's a pretty common example of what we're seeing in the space right now. Okay, and then, so we talked through some industries. Also wanted to talk through just relative size. Ron, you mentioned that bigger deals are getting higher multiples. Presumably the same could be said on these add-ons. When you're talking about the add-ons, are we talking more, sub 50 million enterprise value, typically 100 million? Kind of talk a little bit about that 70% and how it impacts what we're seeing.
So I get asked all the time if there's a magic number. Is it 10 million, 20 million, 50 million? Where a company is worth more. I don't think there's a magic number. I think it's linear. The bigger you are, the better it is. And value size has more relevance than ever. But 30 is better than 20 of EBITDA. 20 is better than 10. But the PE game of multiple expansion still really works. You can buy an add-on. And this is true in a lot of medical practices. I've done a lot of dental practice management with our Tonka Bay friends and others. If you can, even if you have to pay 5 or 6 when you used to pay 4 for an add-on, if you're worth 10, you're picking up 4 turns, and you have synergy. So it really works at every step. If you're paying 12 times, but you're worth 20, you're picking up 8 turns. So I don't really think there's a price break on it, and I think that now the key is you got to run it as a consolidated company. And when we see a company that's 5 divisions and the CEO can't answer a question about any of the divisions, that's a problem. But if you really can integrate, bring the culture, run it as one business, that part of PE, I think still really works.
Okay, and you just mentioned management teams not being able to necessarily speak to things. Let's talk a little bit about what you're seeing as value enhancers at this point. I see management teams as a big driver of multiple, but what else are you seeing as enhancers at this point?
I mean, management is worth, you know, if you're the CFO or CEO of a company, it's not two turns, it's more. I mean, people want to back good managers. And there's a little bit of time value of money. If you're a good manager, there's an actionable plan. You're talking about growth. You're not spending 6 or 12 months putting the right team in place and taking the risk on that. But high quality management is incredibly valuable. So, you know, and then having an actionable plan. Too many times we get called into a business and they say, well, buyer can do all kinds of things with this. Tell the buyer what you're going to do. Be 5 or 10% of the way down that path with a plan that you're acting on. Margins have a lot of value. You know, 20% EBITDA margins or 15 to 20 shows that you're really, it's an indication of the moat that you have as a business. If you're a 5% EBITDA margin, probably more of a commodity. And margin expansion, you know, over time. How are you different? You know, also addressable market. You know, are you, and different buyers look at this different ways, but you have 100 million of revenue on a $200 million market or 100 million of revenue on a $2 billion market. Total addressable TAM, total addressable market matters a lot also. So those are just a few factors, but if you're pretty dialed up with your growth plan, that's a whole different valuation plane than I'm an entrepreneur and, you know, on the deal I want to leave and I don't know what the company should do. And all too often we're presented with that, and then we're strategic planners talking about what one could do with this company that they have no plans to do.
Okay, Shani, anything else you'd add from your view?
Yeah, I mean, those are the big things, and I'd say kind of more smaller on the margin are your list of customers. You know, how big is that list? Any concentration in that list? Length of relationships of those customers. You know, the stronger those relationships and the stronger the length of those relationships, you know, wallet share with those customers, those are very valuable assets to companies. And I would say, you know, kind of to a lesser extent, your IT systems. We've invested, I'm sure you've seen a lot of companies who still operate on QuickBooks. And these are, you know, family businesses that have grown up and just haven't grown up their IT systems. But if you've made that conversion already to a stronger IT system, I think that is a very valuable asset. And having gone through that already, you know, we invest in plenty of companies who are going through that, and you know, it's hard, it's expensive, it's timely, it's distracting, and if you're on the other side of it, it's much more valuable.
And I think it ultimately comes down to quality of data is what it leads to, right? The better pulse you have on your company and the ability to speak to sales and profitability, not just at the financial statement line item, but at a granular level, the more confidence people are going to have in investing. We talked a little bit while you're going through your presentation. The question came up is what's driving everything in 21? Was it tax, more tax? Let's talk a little bit about some of the drivers that we were seeing to the 21 market.
Sure. So to refine that answer a little bit, I don't think in private equity tax drove. You know, they're investing over all cycles. I think in the entrepreneurial world, it proved to be a bit of a fallacy, but who knows what's going to change, but it clearly caused some acceleration of deal flow last year. But look at the stimulus that we have and the profits. I mean, when you pour trillions of dollars into the economy, you've got this robust, you know, performance and capital. Money flow is, you know, pushed a lot on valuation. You know, again, I mean, so many companies have record sales and performance. So we're trying to navigate what's normalized profitability. In some cases, like the pet industry, the market believes that's sustainable and going to, you know, be an uptick, and the convergence to e-commerce and certain things is going to be permanent. In other areas, there's real question marks, you know, on the sustainability of that, and a number of deals that have stalled where EBITDA is double. And, you know, it's pretty hard to argue when no one really knows what normalized is, you know, to transact. But, you know, there's just a lot of positive economic data behind all the auto, market and parts and so, just economic strength, I think is really driving deal flow.
And then Shani, on the lending side of what has really driven the increase in kind of the multiples and ability to lend in this space?
Supply and demand, the money flows. I think it's the same answer. There's so much money from so many different sources, bank and non-bank sources, who are trying to put their money to work, and they, these higher multiples, they can stretch their leverage multiples that much further, and it's just driving this competition amongst lenders. And it's with the performance of the companies, it's not going to, this performance is not going to last forever. So it'll be interesting to see what happens when the music stops with, some of these crazy multiples. So, we value the private equity firms who value the flexibility of their capital structures and tied into the unitranche chart that you put up was incredible. And, we do see that, but when the music stops, what happens there? We haven't seen that music stop in quite some time. So it'll just be interesting to see what happens there, but there's just a lot of money flowing and a lot of lenders chasing after deals.
Anytime you talk tax, I normally would have John give more updates there. We are going to have him run through some specific slides toward the end of this and open up to more tax specific questions there. So I'm not ignoring all tax matters at this point, but it's a broader topic that we will address here in a little bit. From the quality of assets perspective, are you seeing a change? Are you seeing more A assets go, or do you think most A assets are already traded at this point? And this one, Shani, would like to start with you from what you're seeing.
Yeah, there's still good quality assets out there. I think with the strong multiples that people were, purchase price multiples that people were seeing in 2021, I mean, if you could get out to the market, you got out to the market. But we still see plenty of companies who were, busy putting out their own fires with labor and supply chain, et cetera, during 2021, but still high demand, high revenues, high growth. And they're going to be ripe to come out to the market this year. As Ron was saying, 2021 was a great year. This is also going to be a great year. There's still some really, really good companies. We have companies in our portfolio who just logistically we're dealing with other things in their companies this year or 2021 that are ready to go out to the market, probably in the second half of this year. So there's some pretty good companies still out there, especially in these industries that we've been talking about.
I would totally agree. I don't think there's a degradation at all of asset quality. I think there's a trend, though, to these good assets trying to go out early. We just pitched a deal before the add-on was closed. We were pitching the sale of the combined company, and they hadn't even closed the add-on. At full credit for the add-on, and actually trying to get the credit for the next add-on that they were going to do afterwards. And we were, and do this with under a quarter of combined results, where they would do the integration during that first quarter. And this other one I talked about where the EBITDA was 10 million. It's a phenomenal company. In a normal market, you would say, let's wait 12 months, it'll be more. But owners see this incredibly robust market and are trying to rush as quickly as they can. So the buyer needs to get in front, and strategics can. You pay for, you believe it, and you buy it a year before you did, before you kind of should have. But that's the competitive market that we're in, is there's really good assets. They're just going to market a little early. And we got to lean into that because they're really good.
We have an online question.
Yeah, another online question. Back to the conversation about money flows. Have you started to see any impact on the structure of the deals, the structure of the capital structures involved? Less debt, For example, with the upcoming shift in the tax code to limiting the deductibility of interest in future years.
So the question is, have we seen any additional change in structures for transactions?
I think we're very reticent to have earnouts. And the financing market is very robust. So where earnouts may be at the bottom of the pandemic early, probably ticked up, we're very resistant to it. So I think structures are pretty clean right now, and it's cash. I'd be interested in Shani's opinion on the tax deductibility. I'm not hearing as much focus on that as I think there should be. This depreciation and EBIT versus, that. I think that's an excellent question, and I'm not sure the market's as focused on that. It would be interesting to see which companies are really going to get hit that are not focused on it, because I'm not hearing much about something that could be very meaningful.
And I actually am gonna talk about that a little bit too, just because I have the same concern or at least a question mark. It's a big change coming or it's in effect now in 2022. And I'm kind of curious, how does it impact how deals are structured, how they're leveraged, financed, and time will tell ultimately. But I do think it's a great question.
Yeah, we're not seeing the focus on the deductibility of interest rates either. It's just, I don't even know why that is, because it should be a focus. I think interest rates have been so low for such a long period of time. Pricing has been pretty reasonable for a long period of time. And I think that's just, you focus on what the deal, what's the structure at close, and that's your structure at close. Low interest rates, you may project something out, but it's just not a topic of conversation, but it should be. In terms of other structuring issues, other than the high leverage multiples, I'd say some of the other sort of deal terms are becoming more prominent. First of all, speed to close from a lending perspective. These processes with the strong multiples and the strong M&A markets, these processes have just gotten so compressed. And so buyers have to show up with fully financed deals, fully committed deals, fully diligence deals. And, the lenders have to play along with that process as well. And they have to compress their diligence timelines. And so showing up with, fully committed financing earlier in the process than you otherwise would have. I think those are some of the elements of the financing that we're seeing right now, sort of that speed and flexibility to close. That's not an economic structure, but it's just a process structure that we're seeing right now.
We have a follow-on question about structures, stock versus asset purchases, ability for the seller to take advantage of code section 1202 for some, typically smaller companies. Any thoughts there?
So the question now relates to basically asset versus stock, taking advantage of that. Let's start with John on this.
When consulting on deals, it always comes up. Obviously, buyers want deductions, and so that lends itself towards an asset deal. Sellers want preferential rates. With 1202, exclusion and that being able to take advantage of that, usually they can get it. The discussions that I'm having is usually how big of a discount does it end up being in terms of top line price. So yes, usually you can get it. It's just a question of how much does the price come down as part of the negotiation. I don't know if you guys have any opinion on that.
90-something% of the time, you optimize the economic outcome for tax. And the market is sufficiently sophisticated that you adjust the price and you optimize the structure. It's a rare occurrence that a entrepreneurial seller has some passion about structure that is not, economic. And there's 20% of private equity funds that actually don't get taxed and don't price stuff appropriately too. But the vast majority of the market is sufficiently sophisticated to optimize the tax outcome and adjust the structure. You can write an asset deal like a stock deal or a stock deal like an asset deal from indemnity So it's really a math exercise, and I think the market's generally, the market's pretty sophisticated.
Yeah, with the proposed changes to section 1202, is that accelerated deal flow in that space or impacted valuation?
Question is, with the acceleration of 1202, has that changed deal flow?
Certainly, it made us all pause for a minute in the fall and then look at how many, where is this going to impact, or which deals are going to be most impacted, and do we need to be pushing this along? And when Manchin kind of put his foot down, that gave everyone a little comfort that it's probably less of an issue. And but yeah, I mean, absolutely, there were a number of transactions that were kind of starting that were like, we really need to get this done this fall, because what's coming would be pretty detrimental.
I think on top of that, I think the pandemic has had an impact to a lot of people. And a lot of these people that were probably exiting the next, call it 5, 6, 7 years, probably got tired and wanted to speed that up anyway. And then others want to take some chips off the table. So this probably sped those conversations up, but at the same time, still seeing a lot of demand. Shani, I want to go back to something you said earlier around speed up the diligence timeline, and everyone's wanting to get to the closing table much quicker than they had in the past. From a risk perspective, are you seeing additional risks with people cutting out diligence portions of the process, or is it still kind of status quo?
I'm interested to hear what Ron says on this from your side of the table as well. But cut corners, no. I mean, you're still going through the process and doing all the diligence. But sometimes there's that one issue that maybe you would spend some extra time on, dig further, maybe find some other resources to mitigate that. But there are, I'd say, on those kind of last 5 to 10% of issues, you kind of take the leap of faith with these compressed processes. If this is an asset that you really want, that last 5 to 10% of diligence issues, it's not going to necessarily make or break your outcome in the overall table. So it's not cutting corners. I mean, all the diligence is still being done. It's being done in a very, very compressed time. But I do think there are some leaps of faith that are happening. I'm curious to see.
So first, we're doing more work than ever before we launch a deal. Quality of earnings every time. Market studies more frequently. I don't want a 60-day market study calling into the market and not know what my addressable market and competitive position is. If you're going to get a high price, you better be prepared with all the data, with all the market stuff. So we're compressing the timeline to the point, Shani said, being a buyer. I mean, if you're at a great price, you want to get it closed. So time has huge value in the process. It has millions of dollars of value in a process. Every month is risk in a volatile environment. So we're really driving timelines, and we have the demand to allow us to do that. And the best day is when you shake hands on an LOI. It just goes downhill from there. Stuff comes up and other things happen. So speed is leverage. So no, the buyer does all that work, but if they have to close in 30 days, you've got momentum, and it's going to work in the seller's favor to drive through that and get that last 5% over the goal line. So as a buyer, use speed to your advantage. That is the market. And I mean, I take 120 million over 125 million for 30 days early, or something like that, from a buyer that can just write the check when you thought you were going to get 100. And if you're a strategic, you better be able to compete with private equity who knows this game and listens and plays by our rules. So I think that's one of the most important advice is strategic, is figure out how to act quick. You ought to be able to do it quicker. You're in the business, you know it, you can write the check. So speed is incredible, as well as cleanness of the deal. No reps and warranties, insurance, here's the money on this day. it's an essential competitive tool that you can use to your advantage.
Can you talk more about reps and warranties insurance and its impact on the deal? I know we talked about this in some of the plans, so insurance guy, curious for your perspective about how that muddies the waters.
Yeah, the question is, how is reps and warranties impact?
Yeah, you know, it's a bit of a love-hate relationship. You know, until fourth quarter of last year, and I think back now, we were doing it on almost every deal. Except the market got so muddled up in the fourth quarter, we were actually not doing it because the pricing went high. That was kind of an anomaly. But buyers, you know, you have multiple shareholders. It cleans up a lot of problems. When there's multiple shareholders, they don't want to indemnify this stuff. The IRR for private equity funds who will have a lower IRR if they leave an escrow out. There's a lot of mechanics that make it attractive to sellers that are very, very clear. But the hate part is for a banker is what are the exclusions? So we do it as it, you know, we shake hands on the deal, but something comes up. And now you have something that you didn't pre-negotiate and it's not, you know, and you don't have leverage anymore. And the seller thought they were going to have a clean deal. And now we have a issue that could have a purchase price indemnity out on it. So it really gets the exclusions. And it's pretty hard to negotiate what you don't know at the time. But it's a very effective, overall, it's a very effective tool that we use in majority of the times in transactions. And pricing is only a few $100,000 for not withholding millions of dollars for 18 months.
Are there capacity constraints in the rep and warranty insurance industry and size limits?
So in the fourth quarter of the last year, incredible concerns. They wouldn't bid, pricing was double. I think that is clearing a little bit right now, on it, but the market was not in balance in Q4 last year.
So you had some PE supply chain constraints in the insurance industry.
Absolutely. And in the accounting due diligence industry and in the legal industry.
I was going to say that. So we had a question on the capacity constraints on reps and warranty teams. And I don't think you can just end at reps and warranty. Our group was turning work away starting in August last year. We didn't take on anything new because we were so busy. We were so backed up. We just started taking work on for 22 2 weeks ago. So it kind of puts it in perspective how the people we work with, the clients that we have, they know the capacity constraints were coming up. People are getting on my calendar 8 to 12 weeks in advance. I was having private equity firms tell me, hey, we're submitting an LOI. We're going to do this phase 1, this phase 2. This work needs to be done pre-LOI. This needs to be done post. But they knew the capacity constraints were out there, so they were actually reaching out to us in advance to get on our calendar. Because the question that was coming up most by investment banks in the fourth quarter was, do you have a diligence team lined up? If you don't, well, you're probably going to lose some traction there because you're not going to have the momentum. While we're on the sell side, I've never had my report relied on as much by buyers than I have in the last months. During that period, my report was accepted by more parties than I've ever had it accepted it with questions from big 4 firms that came in. They did that 1-hour call with me, had another call with management, and then they signed off on the deal because it was likely some sort of add-on. But we put a credible product out there that people were able to get behind, and the lenders realized it wasn't too aggressive. But that was because of capacity constraints. So it all kind of flowed downhill. M&A attorneys were dealing with the same thing. Investment banks were dealing with the same thing where they weren't able to take things to market as quick as they want to. So I think capacity is kind of the big part of the conversation.
Just to add on to that, when you guys hear capacity, do you think labor? There's only enough hours in a day or a work week, right? When it comes to the insurance market, capacity means can a carrier underwrite and put up the capacity? They look at a lot of times in an annual year, they're going to put up so much capacity. So when you get to the fourth quarter, if they've already used 90 to 100% of their capacity, they just won't look at deals. So the market significantly constricts in terms of the supply available. So that's maybe why you're seeing now, they have the labor capacity, but they also have the dollar capacity.
So I think we're getting closer to when we want to flip over to the tax side. I want to just kind of wrap up with kind of how we view 22, kind of what we see. So I want to start with Shani first, just give your kind of outlook for 22.
I think all indications from information that we see out in the market, people we talk to out in the market, private equity firms, investment bankers, other lenders, 22 is going to be just as a strong year as 21 was, if not even stronger. I know there's talk out there about what's going to happen with interest rates. And yeah, I think we will see some interest rate movement in 2022, but I think in the incremental, small increments that we're talking about, I don't even think that's going to have an impact on M&A deal volume, leverage lending, things like that. So it'll, maybe in 23 will that have a more impact, maybe, but we're just talking about small interest rate increments this year. So I don't think that's going to have an impact, but there's still this supply, demand, the money flow environment that is, I don't see that changing in 2022. I think it's going to be another strong year, strong multiples. If you have a company to sell, still a good year to sell it. Just kind of hold on for a wild ride.
I mean, the macro, I agree. The macro trends have legs and the demand is there. It's about company performance. So can companies normalize their performance, fix their supply chain and their labor? And again, most companies are doing really, really well, but it's not all at the bottom line because of all these variances. And so if we can get a little more stability, a little more supply chain, that's going to create the volume that we need because the demand is clearly there. But I don't see valuation really changing. It's probably more upward pressure than downward pressure. I don't see the lending market really changing. Absent an external shock that we have in the market, I think we just have to normalize performance, and that will drive continued flow into the market. But we've got a few years left here.
I'd agree. I think we're going to see some challenges getting deals done because of inflation, because of supply chain. We're seeing it in a lot of negotiations right now, specifically when it comes to working capital and as the deal is getting closer to closing. People are wanting to understand how the price increases are impacting working capital, what's been done historically, what are you doing now, are you buying inventory in advance? But that doesn't necessarily mean that the volume is going to go down, but I think there's going to be additional scrutiny on the sustainability of earnings during this period and on working capital.
So we're trying hard to get that there's excess working capital in a bunch of companies who have stockpiled inventory. We're not really winning a lot of that. But until you come down, that's what you need in order to generate this level of profit. And there's big inventory revaluation issues, which go to accounting due diligence. So working capital is a bear right now. And some are low, some are high. That's a great topic. And you really need the accounting help, to get your arms around it, because the variances, both the accounting component and the absolute levels are really tricky.
I think the biggest thing there and what we're seeing on a regular basis is that negotiation piece happening probably earlier than it used to happen because everyone knows this is happening. The bigger challenge with it is coming to that mutual agreement of what's happening now is normal, despite what may have been happening 6 months ago. People are still trying to get back to levels where it was before all the capacity issues popped up and supply chain challenges, when that's just not the reality. The point of working capital is kind of what's normal operations for roughly the next 30 days. And I think all of us up here would agree that this isn't changing in the next 30 days. So that's been the biggest challenge. With that, I'm going to turn over to John to give a tax update.
I don't know if you want the slides. So I'm going to hit on tax in a couple. I'm going to start with Build Back Better. It's theory, it's a proposal, it's likely dead, if not pretty close to dead. I still think it has some relevance in that it's an indication of where the administration wants to go. I wouldn't be surprised if, even if this is officially declared dead, certain proposals make it into future attempts at legislation. So I think there's some value there, but I won't go too nuts on it. I want to hit on a couple of state and local tax items as well. There's been some changes. Minnesota joined about 20 other states and some changes that I want to hit on. And then a couple things that are in effect now, starting in 2022. I just wanted to hit on briefly. Some of them have been mentioned already. So Build Back Better, there's a lot there. I just picked out a couple of the highlights. There's corporate changes, so I'll briefly hit on that, and then there's the individual pass-through changes. And some of these were impacting how we looked at transactions and trying to get things done in 21 versus pushing out into 22. So the big corporate change, the one that got the most headlines was the big, new alternative minimum tax based on book income for the larger companies, the over $1 billion. Obviously, that doesn't impact a lot of our clients, but something that would be interesting to see how it would impact how companies operate. In addition, for larger companies publicly traded, there was a new excise tax proposed on corporate repurchases of their stock. The next two items, this can impact companies that are not public, how international tax deductions. So there was two main ones that would essentially increase the tax rate on foreign profit. So reduction in the deduction for global intangible income, so for foreign subsidiaries, and then for foreign export sales. Effectively, the rate's going to go up for those two items, so that's what was proposed. The next group of items I got to spend a lot of time talking with people about and the potential impact. So the first one is broadening the impact of this net investment income tax. So that's been in the code for a while. It applied to essentially passive income, interest, dividends, capital gains, and passive income from K1s or investments in partnerships or S corporations. The change was broadening that to active business owners as well. That was the proposal, which would significantly change the game. It would essentially subject all K1 income to a self-employment tax equivalent. I mean, the 3.8 is essentially, once you're over the FICA, that's the 1.45 and the additional 0.9. So it's essentially subjecting all K1 income to a type of self-employment tax equivalent. That would be a significant, change that would impact a lot of our taxpayers. And that threshold was only $500,000 for married filing joint. The next category was the Sur Taxes. They're pretty high Sur Taxes, and a lot of owners wouldn't necessarily be paying them. But in an M&A type transaction, that's where we were concerned, kind of the home runs, the bigger type of deals, is where we were concerned that these could come into play. So it's a 5% if you're over 10 million of modified adjusted gross income. The part that people didn't talk about too much that we were a little concerned about is threshold for estates and trusts was only 200,000 where you could be paying these Sur Taxes. So a lot of our clients are engaging in estate planning and doing other strategies to keep stuff out of the estate. So this could potentially come down to a fairly low level, especially in a transaction environment. And an additional 3% if it's over 25 million, and that threshold is only 500,000 for estates and trusts. So we were concerned about these. Again, these are proposals. I don't think it's too likely it goes through as is. It's just a question of what resurfaces in other legislative attempts. I'm going to hit on the next one in a minute, and so I'll skip on it just in the interest of time. But the other one that was in the House version of the bill and just plays into the next thing I want to hit on is the House wanted to raise the SALT or the state and local tax cap from 10,000 to 80,000. That was put in place by the Trump Act, essentially limiting the deduction of state and local taxes to 10,000 for those who itemize. Ever since then, people have been figuring out how to work around these rules. So we'll kind of hit on that in a minute. But that raising that cap, a lot of Democrats in particular are really pushing hard on this. The states that have the highest rates are, their residents are most impacted by these higher higher cap on deductions, so they're pushing hard for that. So, and then there's some more restrictions on particularly larger balance IRAs. We're talking, you know, the mega IRAs, 10 million, I believe. But also Roth conversions. We have a lot of higher income people that do the Roth conversions over the periods, and those would be limited as well as part of that. Again, I don't want to, it's theory. At this point, I don't think it's too likely it moves forward, but I think it's relevant just in, you know, looking forward at the types of things we want to be monitoring. So the next one on the state and local taxes, Minnesota this year joined about 20, 21 other states in having some sort of an entity level tax deduction. So this is similar to like a composite type tax. So for those of you who are familiar with that, essentially the entity now is subjecting itself to tax and taking a deduction for those state and local taxes at the entity level. On the individual side, they either get to exclude the income in that state or wherever, and then they get a credit. So from an individual standpoint, you're kind of neutral. But from in the states, but on the federal side, you're deducting those state taxes, and it loses its character as a state tax. So you're deducting it, it's just reducing your business income. And so you're getting the benefit of that federal deduction. So the reason all these states are more than willing to change their rules and give this benefit to their residents and those doing business in the state is it doesn't cost them a cent. They're essentially giving their residents a federal deduction, and so they're able to benefit from those state tax, or get the benefit of a deduction for those state taxes where previously they were limited. So states are changing their rules. There's a lot of states. There's a lot of different kind of variations on these rules depending on the jurisdiction. But Minnesota enacted this as well. Kind of uses a corporate format where it looks at your apportioned income to Minnesota, and you can elect a deduction to take a deduction for that. You have to be a qualified entity. So the big, any partnership or S corp, but there's some limits on ownership in Minnesota. So you can't have a corporate owner or either a C corp or an S corp or a partnership owner as well. And then partnerships can't have recognized trusts as owners and still take advantage of the state and local, or this entity level tax deduction. So that's Minnesota. I don't know if anyone has any questions on that. Essentially 20 something states have done something similar to kind of get around this cap, but this is a big thing. A lot of states are doing it. They're either becoming effective in 21 and for those that aren't 21, the rest are basically 22. So there's a handful of states that have been working towards this. Yeah.
Question came up about the issue of sales tax risk coming up in the due diligence phase of transactions. Companies that operate in multiple states, but may not have had nexus in all those states for a long period of time, those sorts of things. How often do you see that coming up in transactions in the due diligence phase?
Well, Joe will be able to weigh in as well. From my standpoint, we talk to our clients a lot about this with the economic nexus concepts that are out there. I think just about everyone has some exposure in these spaces is what I'm seeing. It's just a question of measuring and trying to, when we're talking with our clients, it's go for the big, if you're going to start at the higher risk areas, work your way down. And so if they're going to go to market, you want them working towards getting in compliance, getting their processes in place. But, ultimately, I don't think I have anybody that doesn't have some exposure. I don't know, Joe, if you have any other comments.
Yeah, I would say this is probably one of the areas in the lower middle market that we see impacting deals the most. I have actually flipped over to the point of saying it's not unusual for me to ask clients to start our tax diligence before we start financial, because there's going to probably be a significant tax exposure on the sales use nexus side. We're even doing it on a lot of our sell sides now. where we're trying to get ahead of it. If we know that their ducks aren't in a row, we're trying to get ahead to identify what that exposure may be. Start getting some exemption certificates and mitigating some of that up front, because we know buyers are going to be calling this out, and they're probably gonna be very aggressive on it and finding total exposure versus trying to isolate what it would be.
Happens all the time. High prices, buyers, this is one area where buyers don't want that exposure. If they're paying a lot for the company, they're not gonna take this liability. So get in front of that issue and do work ahead of time to, because the X exposure can be a huge sum of money, and you don't want your deal to be held up over state tax.
Are wrap and warranty insurance policies excluding sales tax? Wrap and warranty insurance, or is that something you can opt in?
Can you repeat the question?
The question relates to the reps and warranty insurance, and whether you can have that as part of the policy. And I think Joe would make sense to kind of give an update on that one.
Yeah, I think it's generally excluded and they're gonna hold in on the diligence and make sure, it comes up on every single reps and warranties call. And we see a wide range, whether, they kind of punted because they didn't view it as material, but it's always a topic of discussion. And reps and warranties carriers are gonna take that risk if nobody else at the table is gonna take it.
Yeah, so to briefly summarize for those people that are not here, the answer is when the reps and warranty team's having their call, they're bringing the tax diligent legal team, they're bringing the environmental, the financial teams, they're bringing us all together, and we're having questions. They're not going to underwrite anything that we're ultimately calling a known exposure. So in these cases, they're known exposure, so it's not as simple as being able to put in the reps and warranty that this is going to be covered by that. It's not going to be covered.
Anybody having states have the sales and use tax auditor do an initial review or preview? Seen some bizarre rulings against some of the clients I work with, where they claim that the sales and use tax wasn't met, even though they felt they honored everything needed. They come out of the woodwork with something. It means tens of thousands, if not more.
It's a negotiating tactic. They expect that every single time.
Well, that's.
It is a
our-
negotiating tactic at
For
the end of
sure.
the day to try to scare you and then get something out of it. I mean,
It doesn't work.
well, yeah, you don't have your act together.
Well,
versus the sales
ultimately,
tax.
yeah, states seem to have learned that there's so much exposure. They can hire people that have no tax experience whatsoever. They give them their little pamphlet, tell them this is what they do, and it's a moneymaker. And they come after everyone. They ask a bunch of questions, and you kind of have to train them. And at some point, at least with clients I work with, they're like, the time it's costing to deal with this versus paying them something or having them go away, I'd rather just write a check and call it. So, I mean, I don't know that that's sustainable, but I know that people are making those kinds of business decisions because they don't want to deal with it. I'm not saying it's right, but I totally understand. Like, if you want to pay for my team, or you want to write them a check, you're spending the same amount of money or something similar either way, is what ends up happening.
On the pass-through entity thing for Minnesota, have you guys worked on the gap side of that perspective? Because I understand it's an annual election, but yet it's called a corporate level tax. So with a flow-through entity, it's kind of odd.
It can be iffy, I think, and I'm tax guy, so take what I'm saying on the gap compliance side with a little bit of a grain of salt, but I believe because it's an annual election, the deferred tax stuff gets kind of like I don't believe you necessarily have to do it. I think you can justify not looking at it from a deferred tax standpoint because you're not necessarily going to do it the next year.
And that would include treating that as a distribution versus a tax expense.
Well, I think you absolutely want to treat it as an expense. That's the benefit of it. If you're not going to treat it as an expense, there's no point in making the election. That's where you're getting the benefit. So on the next thing, just a couple of changes that are kind of coming in effect. And one of them was already brought up with the 163J. Another kind of big one is now, as the law sits today, starting in 22, R&D or research and development expenses are now subject to capitalization. So people think of R&D with respect to the credit, and they certainly is some overlap, but there's a lot of R&D type activities that are going on in companies regardless of whether or not you take the credit. And now they're subject to capitalization in the 5-year amortization period. So people just need to have this on the radar and plan for it from a cash flow standpoint. We have a number of clients that have seen huge R&D credits, but also huge R&D expenses that now, I mean, this is, some tax bills are going up millions of dollars because of this type of, because of these rules. Obviously, over time, the impact gets smaller as you start to build the amount of amortization expense, but these first couple of years, it's going to be especially impactful for companies. And last thing I wanted to hit on, and it was already brought up, is this change in 163J. So it's changed a little with some COVID relief type items, but essentially interest expense is now limited to 30% of adjusted taxable income. What's coming up new in 2021 is the definition of adjusted taxable income is changing. So up through 2021, I should think, starting in 2022, but through 2021, adjusted taxable income has been defined. It's not exactly the same, but it's close to even. So you get to add back your depreciation, amortization, interest to determine kind of the threshold. Then 30% of that is the cap on how much interest expense you can deduct. What's taking effect, or what's in effect now in 2022, is you don't get to add back your depreciation and amortization anymore. So the definition of adjusted taxable income is changing. So when you think about it, I mean, I have this conversation all the time, especially at the end of the year. If I buy this, I can deduct it all, right? The bonus depreciation and all those things where people are really able to manage taxable income and depreciation, but now we have to kind of measure that up with interest expense, think it all the way through. If you can't, I mean, it's just, I'm curious, I really am curious how it's going to impact transactions and how they're structured. I think it just needs to factor into the analysis, and ultimately that's what's going to happen. They'll look at cash flows, and losing this deduction or deferring this deduction, you don't lose it. It just needs to be part of the analysis. So that's all I wanted to go through, but I don't know if there's any other specific tax questions or any questions for anybody really.
So we have about 5 minutes left here, so if there's any other questions from the group, you can answer those. The one thing I'd add from a deal perspective, the R&D expenditures that are not going to be capitalized from EBITDA perspective, that's still not going to be something that necessarily we get credit for from earnings. We have a lot of people that are asking and wanting to get credit for R&D and trying to capitalize that, but GAAP still is not like that. And from a deal perspective, still not real.
The question I have is, I'm wondering, you talked about the constraints of labor and all those things. Is that dramatically worsened in outstate Minnesota versus metropolitan area? Recently working from Mankato, my sense is it's a lot more severe out there than it is in a more populous space. Is that true?
So the question relates to labor and if it's worse in more rural areas than urban, specifically here in Minnesota. Shani, you want to take this?
Yeah, we invest in companies all over the country, some in urban areas and rural areas, and that's exactly the case. Trying to find labor in rural Georgia versus, closer to Indianapolis it's much more difficult in the rural areas, that's for sure. And to attract and retain the employees, companies are getting very creative in what they're doing. Attendance bonuses, it's not just money that people are looking for, it's other benefits, time off, part-time. You have manufacturing companies that have very specific shifts, and you work your shift or you don't. But now there's some flexibility where you can work a half a shift here, half a shift there. So just flexibility in your hours, things like that, just to have the bodies in the door. That is absolutely what we're seeing in our portfolio.
I would say that's all the questions we have. Appreciate everyone's time and thank you for having us.
Thank you, everyone. who's in our
Thank you,
virtual
panelists. We have a 15-minute break. We are back on at 9:45. I should double check that. Yeah. Right? Good. 9:45. Thanks again, everybody.
I operate international. It's sort of whole field. It's amazing, like dealing in a big operation. I have different tax rates. And a lot of our different state strategies are taxes that are the software budget.
Hey, Pete, could you give Roseanne a call? She wants to try and work with the Pingo and some other things about, getting a little ahead.